Good day, everybody. This is Jim Kenny speaking, and this is the Option Professor weekly market update for November the 23rd and 2018. As each and every, well, quick background on myself. I'm a graduate of Boston College, and I've been involved with investments for decades, and so I have a pretty good understanding, in my opinion, of the stocks, the bonds, the commodities, and the currencies. And we're going to cover a bunch of these things right today. Again, I always say past performance is not necessarily indicative of future results, and that short-term trading and option trading does involve substantial risk of loss. So you should consult your investment advisors, your clearing firm, and your good common sense on what strategies, if any, might be suitable for you, because none of these things we talk about are right for everybody. So look into that, of course. All right, now overview here. We've had a market that has been dropping, bouncing back up, and then dropping again. And so many of you, I'm sure, are involved in the markets and probably trying to figure out what might come next. Again, I'm going to give you my views and my opinions today. And there is a lot to cover because a lot of the markets are going back and forth quite a bit. So let's start out with the S&P 500, which is your broad-based index. And today you can see the market's down again after the Thanksgiving holiday. So there has still been a little bit of situation where the selling has come in. Not tremendously, but it is definitely still on the books here. Okay, right now, here you go. You're at the S&P 2638 on my screen here, and you can see that it is down about 11 points today, and then you can see the graph right there. Okay, so my view on it right now is that the 2600 area is an area of support, and it may hold that area. So that would be your first line of defense as far as if you wanted to remain positive on the market. Underneath that, you're at the 2530 area, which is the 52-week low. Can you see the 52-week low, 2532? Okay, so there's your second line in the sand. Your next one is right here at 2600. The lows for the summertime, which was June, July area, for the S&P was the 2591 was the high in May. I'm sorry, a little bit earlier than that. 2591 was the low. I'm sorry, the low in May. The low in April was 2552. And then the low in March was 2586. And of course, your February low was 2529. So there is some lows that we're going to be coming into. Even if it did break 2600, that could catch the falling knife. But right now, you have to admit the momentum is down, and the RSI probably is getting down pretty good as well. And again, there has been a lot of selling. So you do have to be somewhat concerned that after all the selling has gone on, that we could get some kind of a snapback into the end of the year. The two things that could engineer a little bit of snapback would be at the end of this month of November, when Trump goes down to the G20. There's some happy faces going on with the Chinese and U.S. And maybe if the market is still somewhat weak going into that meeting, maybe Trump could announce that he's not going to go ahead with the additional tariffs. I think brings it up to 25%, and maybe just stick with the 10%. And that would be obviously mildly positive. And then, of course, if the Fed, if they do hike in December, which I still think is on the cards, which I'll get to in a minute, if they were to be a little bit more of, we're going to now take an extended holiday from additional hikes in 2019 until we see more data. So if the Fed hikes and then puts out a dovish statement, if Trump can make nice with China and possibly at least suspend the additional tariffs, then you may have a recipe for a turnaround. And the turnaround, in my mind, would probably either come from this neighborhood of 2600 or in the neighborhood between 2530 and 2600. Okay, only time will tell. Now let's look at some of the internals under the hood that I watch and give you an idea of what's going on. The first thing I'd like to do is I'd like to show you where the moving averages are. Now, I like to look at the moving averages because they're based on price and time, and they're not based on people's opinion. And in my view, when the markets get pretty 50% above their moving averages or beneath their moving averages, there's a probability, I think, that they will snap back towards their moving average. A good case in point would be Amazon. When its moving average on a 200-day was at 1550 area, it was trading at 2050. That's 500 points above its 200-day. That's very extended. And you saw Amazon not only went back to the 200-day, but went through it. So it is, in my view, something to keep an eye on. So where are we on the 200-day and the 50-day? Well, we're at about 2,800 on the 50-day. There should be plenty of resistance at that level if it does try to rally. And then 2760 is your 200-day. And that 200-day is now going down. Not a lot, but a little. It used to be in the 2760, 65, 2770 area. And now it's at 2760. So it is declining just a bit. But again, if they do invert, the longer we stay underneath 2,800, the longer we stay underneath 2,760, those moving averages will roll over. And if they invert, that's not going to be a positive by any stretch of the imagination. I've been doing this for decades. There's not a lot of fear out there, even despite this decline. Everyone is still hearing about buy the dip. Everyone is still thinking hang in there for the long term and that kind of talk. So again, as far as a panic low, we have not seen that at all. And the VIX, of course, has been elevated, but it has not been a blow-off type look. So again, there's your moving averages, and that's what obviously is a problem, is that your moving averages are above the market and they are declining. All right, now what about the VIX? Oh, by the way, yes, a couple of things on the option front before we move away. Can you see when we're up at 2,900 and stuff? People have listened to this broadcast or talked to me personally. I did suggest that they investigate collar strategies where you sell an out of the money call and buy a put. And obviously, had you done that when the market was extended, the put that you bought using the premium from the call would have offset a lot of exposure, if not most of the exposure on the downside, depending upon what strike prices you selected. And again, the upside that you would have forfeited by selling the call did not come into play because the market rolled over. So again, collars way up there. Now, what about now? Now you have a lot of people that are maybe thinking about selling out their stocks because obviously they don't like their account going down and they're nervous about that. Well, what they might consider doing is replacing their positions with limited risk options going way out in time of 1 or 2 years, something like a leap. And why would they do that? Well, because they certainly wouldn't want to be selling out all their stocks near the low here if this is going to be the low. There's no assurance of that. But if you are selling out of things that are, companies that are making money, then you might want to replace those with long-term calls. What would that do for you? What that would do is would limit your risk. So if the market collapsed down under 2,500 and became a real nightmare, your risk would be limited to the premiums you paid for the long-term options. What it also would do is not get into a situation where you sold all of your stocks on a low point, and now you have to worry about how to get back in. So the strategies, when it's up high, I suggest you look at the married puts and the collars. When the market's had a big drop and you're thinking you might want to get out of everything because obviously, the losses on the paper anyway are piling up a bit, you may want to consider the concept of a long-term call, a leap or something like that. Again, you have to consult your own good common sense, your clearing firm and other people who could find out what is suitable for you. But if you have questions on the actual tactic, I'd be more than happy to give you a hand as far as explaining the use and the risk of the collars, the married puts, and the long-term calls. Again, my email is optionprofessor@gmail.com. That's OptionProfessor@gmail.com. And you could shoot me an email with a question and also some type of contact information so we could discuss your question. Okay, moving along here. Other indicators that I look at would be the VIX. And the VIX, in my view, has 3 basic levels to it. One is between 10 and 15. If it's in that area, the market seems to be very, very firm, and the likelihood of advances is pretty good between 10 and 15. When you get between 15 and 20, the market may be more stable, kind of trading range oriented. And of course, when you're above 20, you run the risk that there could be some kind of a parabolic move to the upside. As you can see, when you're above 20 in January, February timeframe, Okay, that's when you can go from 20 to 50 if it goes parabolic on you. If it goes above 20 and just can barely go to 25, which is kind of the environment we're in now, then, of course, the drop may be muted and it may get back on its bicycle. That's what your hope is right now if you're bullish, is that we are just going into the 20 to 25 area on the VIX, and that the lows we're going to hold between 2,500 and 2,600, and that this thing will get back on the bicycle with possible positive news out of Trump and China, and again, a more dovish statement coming out of the Fed in December. Again, if that's going to occur, then we're not going to probably get much higher than 25. And if it starts getting under 20, at least you could count on maybe stability. And if you get under 15, I would think you're back in a bull situation. Okay, so that's what the story is on the VIX. And I don't make up the numbers, the VIX does. So my view is just to kind of follow along with it. All right, other things that are problematic but might be hitting a lower point, the transportation average. They led us on the way up, the Russell and the transports, and they led us on the way down. Right now, it's stabilizing at about up 11 here today. Let's take a look at the graph, and I'll show you what I'm talking about. The transports, once it started moving up from about 10.5 and then moved up to 10.8 and then above 11, that was indicating a little bit of a turn up. You can see that low surrounded by low, or where my cursor is, the low surrounded by higher lows. That's your turning point. Now it goes up here and it starts going sideways, and it almost gives you a little bit of a head and shoulders. You got the shoulder around 11.5, you got the head a little bit above 11.5, then you got another shoulder around 11.5, and then when you broke the neckline at about 11.4, it was sayonara. And basically, that's when the markets rolled over as well. So right now, if we can get the transports above about 10.8, then I would think that the market is turning and could be quite constructive. It could be setting up for a 1-2-3 formation, because you see that tail that my cursor's on? That's surrounded by higher lows, and that's positive. Now, we had a nice spike. We came back. We haven't taken out the low. And if we take out this 11.8 area or wherever that high is right there, that would give me, if I was bullish, some reason for positivity. Okay. Now let's look at the other one that was a leader, which is the Russell, and that gave us a good signal on the way up and the way down. On the way up, you could see right here that it bottomed with the tail. Again, they tend to have a little bit of a tail at the bottom, surrounded by lower highs, higher lows. There you got a tail with a higher lows, and then once it got above 1600, it was bam to the upside, right? But again, once it broke under 16.5, actually, I thought once it broke under 17, it was losing altitude, because look at those lower highs, right? So once it broke under 17, that was a bad sign. And once it broke under 1650, that was about it. So again, you had a big drop down to 1450. You had the rally back up to about 1590, 1580. You had the pullback now, hadn't taken out the lows, so that's a good thing. And now if we can take out the 1580, then you've got a shot that this thing is actually turning. But all of these averages have got their moving averages above the market. Transports and the Russell both have their moving averages above the market. And the Russells come in right around 1600, and they've inverted to the downside. So again, it may not be very easy for this thing to turn around. If we blow out 1450, obviously you can see in the last 52 weeks, there's not much underneath it. So then, where would it go after that is obviously it would seek longer term lows of which to bounce off of. But right now, you're in crunch time. If this thing can hold 1450, you get positive news at the end of November, you get positive news out of the Fed, there's a possibility for a turn. But again, it is a downtrending overall situation. So you are sticking your head a little bit into the buzzsaw here. But, sometimes that's where you get the best values. Okay. So anyway, that's the story on some of the indexes to give you a little idea on what I'm seeing and what might be going on. Again, with regards to some individual stocks that obviously people watch, let's look at Microsoft. These are the ones that are the big leaders, when it's going up. So let's take a look at what these guys are doing. Microsoft is again, you got a tail down there just under 100. You certainly don't want that taken out. And again, So there's your line in the sand just underneath 100, where I guess it hit last week. And if we can stay above that 100 for a while and get some decent news, this thing has a potential to have a little bit of a move back up. But again, let's take a look at the moving averages, because they don't lie. They're based on price and time. And let's take a look here, because if it does start taking out the 100 mark, there's a little bit of room on the downside. If you're in this stock, married puts would be something to at least take a look at, because then you'd have some kind of a floor underneath. Yes, it'll cost money. Yes, you'll lose the premium if it rises. But if it goes into the toilet here, it would be nice to have an umbrella if it starts raining hard. Again, that's where I was getting that 101 area, right around 100, because that's the 200-day. We're back above it. That's good. Get above 107, that's the 50-day. That would be nice. But again, if it gets under this lows of last week, there could be more downside to come. So if you're looking for a bouncing trade, that would be an area from last week's low to see if you can get a bounce out of there. And if you're looking, for a sell situation, if it starts taking out that 100 mark, then it would be back underneath both the moving averages. And who's to say it couldn't go down to 80 under certain circumstances? Okay, let's look at another one that people keep an eye on, which would be your Apple. If everyone's telling me the 170, 180 area might be a place to take a bite of the apple. Well, you got another shot out of here, 172 today. I was thinking it might go down and test that low of 150 under certain circumstances. Again, I think I've read this, and I can't guarantee all this information I hear and read, but I heard that 60% of the company is these iPhones, and if they're not going to tell you how many they sold, that's a curveball, and a curveball that people might not be expecting, and so that makes people concerned about the company. Their services business are going good. This company is an icon, of course. But, GE was an icon 30 years ago as well, right? So bottom line is, got to keep an eye on things. You don't want to fight the tape. Right now, if you're long, you're fighting the tape. And fighting the tape is not a good idea. Marty Zweig, many, many years ago, said, don't fight the tape, don't fight the Fed. And that's probably pretty good advice. Again, when it's up at 230, where was the moving average? It was down around 180 and something. So again, when we're up at 230 and the moving averages are down in the 180s, that's when I suggest people investigate the collars. Sell the 240 call, buy the 220 put or the 210 put, then it goes down. You got coverage at the strike price, and now it's in the toilet here, and you've covered yourself from that risk. Again, if you need more information on the strategies, either ask your persons that you work with or shoot me an email, no problem. Okay, so anyway, there is a gap here at 170, and you can see it is trying to fill that gap, and that might be an area, 160, 170, that if it holds, might be something to look for a bounce, because you got some gap right there, right above 180, and if things turned, it might go up and shoot into that. Again, the volume has been very high during the sell-off here. You can see the peaks there and peaks there. So again, this would be a neighborhood if you want to take a stab at a long-term call because you want to have limited risk. That'd be something to investigate. Basically, if it can hold this area, there's a possibility that could turn up as well. Again, if we break underneath this 170 area, I would say that the testing of that 150 would be in the cards. Okay, now let's turn to Google, another one of the big growth leaders. And let's take a look here and see what's going on. All right, so they're down 12 here today. I thought around 1,000 might be a worthwhile area to take a look at it, but again, that hit that 1,000 last week, and as you can see, it wasn't a bad place to take a shot. It went up $50 off of that point, so that was not a bad point to look at, and it still looks like a good point, because if it blows out the 1,000 area, then it probably will take a shot at that 52-week low, which is at 980. Again, you don't want to fight the tape, and the tape is coming down. If you want to play pin the tail on the bottom, that's one thing. But I would keep my leash fairly short on these things, because if these lows hold fine, but if they don't, again, like if we're going down to 2520 on the S&P rather than hold this 2600 area, I would imagine you get 980 on this thing. But again, when it's down, you price out the long-term calls, leaps, and things like that. And if you think in the next year or two there'll be a turn in this company and they'll get back on the bicycle, then of course then it would be a situation that you've taken a shot at it while it was low. The premiums were where they were, and your risk was limited. You got no knock at the door for margin calls or forced liquidations, and you know exactly how much money you have at risk to the penny, because limited risk options, uh, give you a limited risk situation. Okay, now. And again, Google's problems could also be, regulatory or something like that. How they use the data, that's the big thing, right? Facebook and things like that. So, if they get a lot of heat because how they're using the data, that's probably one of the reasons some of these companies like this are having some problems, because you don't know what the government's going to do as far as investigating how data is being used. Okay, and the last of the grow guys that I was going to go over is Amazon, and take a look at that. They did warn that their holiday season might be a little lighter. Of course, they're making a lot of money, but the thing that dawned on me, I saw a graphic that said that the revenues for Amazon was about 200 billion or something like that, and Walmart was almost twice that. But the valuation of Walmart was only right around a third or so, or right in that neighborhood of a third, 40% of Amazon. So that right off the bat told me that the valuation is extremely high on Amazon. In fact, the PE ratio used to be way over 100. You can see right now it's dropped well under 100. It's got a tail right there at 1400. And the 200-day average and all that stuff comes in around 16 to 1700. So is it possible to get a 100, 200-point move on this thing? It is. If they, come out with some good numbers at Christmas time or whatever. And again, the line in the sand has been drawn at 1400. Again, another company that if you really are a big believer in, and it is now 30% off its high, investigate the long-term equity, the leap or just the long-term call. See if you think the price is reasonable. You'd have limited risk, and you would have a situation where you would have a position that exactly to the penny how much you're risking on, and you'd have time if you went a 1 or 2 year out to see things turn around. Again, trends are short-term trends here definitely have rolled over, so you are fighting the tape a little bit, but you're also getting it at a discounted price. So you got to outweigh those two items and figure out what you think is best for yourself. But that gives you a little bit of an input on the things on some of the stocks out there. Okay, now some of the sectors, everyone's saying, value stocks might be the way to rotate in. Let's look at some different things out there. Like this is the ETF for Fidelity Industrials. And again, let's take a look at the chart here and see something to talk about. Well, it really got sold off 150 down to 125, right? And now, of course, it had that rally, and now it's have the pullback. So if we can get above the 137 area, again, then you could build a case that there could be some rotation into value. But right now, obviously, there's not a lot of price evidence to tell you that. But getting above 137 might give you some idea that there's legs in the industrial sector. Another sector is materials. And again, there are many, many ETFs. I'm just looking at the Vanguard one. Vanguard Materials, again, big drop from the 145 area this year. To the recent lows that we saw here at, let's see here, just move that chart up a little bit to just around 110, a little bit above 110. Had to move back up to 125. Now the pullback, if we get above 125, might be something that might be making a turn down here, and that might qualify for something in the value sector. And then a lot of people are talking about emerging markets possibly making a turn. Let's take a little look at emerging markets. And in emerging markets, you're looking at a market that still looks like it's having trouble, but getting above 42, I think, would be very interesting for emerging markets, and then above 44. This is the ETF iShare for emerging markets. And again, it does look like it might be trying to make a turn, but it would have to give me more strength above 42, 44 for me to feel like the actual downtrend might be breaking. Because you can see the high points have been not getting taken out, right? High points not getting taken out. So if you take out 42, that'd be the first time a high point was taken out since the thing started dropping pretty much, right? Okay. So keep an eye on that if you're an emerging market guy. Other thing out there would be the ones they've been touting for all year, which never seems to go up, which is your financials. Of course, J.P. Morgan has done pretty good, but the overall sector has not exactly been on fire. You can see everyone try to jump into this stuff at the 30 level. This is a ETF, so there's a whole bunch of financial stocks in there, which is why the declines have been muted. You got individual stocks like Goldman Sachs that have been really nailed. But anyway, you got the low there at 25. So that would be, you see that tail with the highs above it. That's your turning point. Now you had to move back up and you pull back down here. So if you can take out 27 and a half or so, 27 and three quarters, you might be able to build a case that this thing is turning back up. That is a very high volume sell off here, right there in October, where we went down towards 25. And that's a good sign if you want to feel like the selling might be behind us a bit. And then again, you need more price evidence of it turning up for you to really feel like you can make a statement like the banks might be good. A lot of people have been saying that all year, and they've been losing money doing it. Let's talk about energy, because we know oil has gone way down. And let's see what that looks like. As you can see, the whole world was thinking we were going to get a $100 crude, and they're not thinking too much like that anymore. Again, the supplies coming out of the U.S. in a bunch of different ways, the Permian area and other things. Obviously, the supplies have been pretty steady. I think the Saudis said they were going to cut supply in December by 500,000 barrels, but I'm not sure. I don't know if they're still sticking with that. At any rate, you can see we're making new 52-week lows here, right? 52-week low today, 63.44. Okay. Again, definitely the fighting the tape if you're buying into this thing. Having said that, a lot of volume. You look at the volume in October and November, very high. And then so that's telling you a lot of the bulls are coming out of it. And selling nor buying lasts forever. So there you go as far as that's concerned. Above 70 on the energy sector might be what's necessary to see a bit of a turn here. But realistically, a trading range might be the way it'll go. Let's go around the horn, as I like to do, and look at all the different things that we didn't cover here. Let's start out with the gold index, the GDX. These are the mining shares. And again, I've been saying that I think there could be a turn here. Inflation seems to be picking up. When I go out to the store, I don't know how you guys are, but I see the prices higher on everything that I'm buying. So I see price inflation out there. And I think because of the tariffs, companies are going to try to increase prices while the consumer is spending, while the unemployment rate is 3.8, and they're going to try to juice these prices. And that's inflationary. The other thing is wages are picking up a little bit because the employment situation is tight. So I think people are not really acknowledging the inflationary situation in the system, and I think that again is why the gold miners bottomed here at around 17. That has a higher low there at 18, and then it's got a little bit higher low there. And if we hold 19 and start taking out 21, 21 is going to be some resistance. But if you take that out, this could be a turnaround in the gold sector. Not talked about much, okay? But you do need to see more strength. You got to take out this 21 for it to really look like it's going on the bicycle. The moving averages are turning up. That's not a bad thing. Okay, now let's look at the dollar, because if the dollar drops and the inflation comes back, you would think that would be good for the gold. So anyway, on the dollar, it looks like it's having some trouble up at 97. Let's take a quick look here. 97, 98. Is it giving us a head and shoulder? You got the head up there around 98. You got a shoulder at 97, another one at 97. You break under 96, that could be telling us that it's rolling over. And certainly breaking under 94 would tell us that maybe on a longer term basis, the dollar is going to lose strength. So this neighborhood here is very important for the dollar. If you get to 98, it's back on the bicycle. Gets under 96, it might be rolling over. Gets under 94, it's very much rolling over. Okay, so that's your US dollar. Keep an eye on that. Okay, one last thing here on the treasuries, interest rates. I've been suggesting to people for a very long time to keep their maturity short. We're in a higher interest rate environment. T-bills are paying pretty good on the short end. They were trading up near 3% on a 2-year. Nothing wrong with 3% for a 2-year, in my opinion. And again, if they're short term, you can roll them and roll them and roll them because there are some people who think that these rates have a lot more to go. And again, high yield. So there you go. As long as we can hold this 3%, 2.8, I still think that the bond market still could look like it's in a higher yielding environment. Again, get above 320 and then you're back on the bicycle there. Three even is support and 280. All right, now one last thing is high yield, because that's something with leverage loans and high yields that have poor covenants that could be the Achilles heel to get things really going. And as you can see, this thing is dumping pretty good. This is HYG. Leverage loans, very big boom. Now leverage loans and high yield is liquidity. If everybody wants to come out of these things, it's not like trying to sell Apple where other people may want to buy them. Other people that buy this stuff might be other dealers. And if the other dealers own the same things that the other dealer owns, they probably won't step up to the plate. And that creates a little bit of a liquidity crisis, potentially. And so leverage loans, high yield bonds, they have been under some pressure and they could be accelerating to the downside in the weeks and months ahead if things get sloppy. Keep an eye on those. All right. We covered a lot of material here today, as we always do. And again, I do invite you to send me an email at optionprofessor@gmail.com. If you have a question, I'll try to give you the risk and reward, or risk and, the use and the risk of the strategy or the idea or whatever, and basically give you some more information. So optionprofessor@gmail.com. Until next Friday, I want to wish you all, I hope you had a great Thanksgiving, and I certainly want to wish you good luck and good trading. Again, until next week, thanks for tuning in, and we'll be back with you next Friday.